It wasn't that long ago that NIO seemed poised to post a breakout fourth quarter. The Chinese EV maker had delivery momentum driven by the new brand Onvo, which began boosting deliveries at the end of 2024. It also had a good third quarter when it improved vehicle margins amid a challenging environment, and it launched yet another brand, Firefly, that was positioned to drive the top line even higher throughout 2025. But then the Q4 earnings report disappointed both investors and analysts with poor financial results. So what exactly happened? One of the biggest reasons to buy into NIO stock in 2024 was that the previously mentioned Onvo and Firefly brands were set to drive deliveries higher and generate more sales growth for NIO. Although some aspects worked as planned, the sales volume was insufficient to achieve the top-line growth needed to meet the Q4 targets established by NIO management and that were anticipated by both analysts and investors. In Q4, vehicle deliveries reached 72,689, and that figure breaks down to 52,760 vehicles from the premium NIO brand and the remaining 19,929 vehicles from the family-orientated brand Onvo. The sales result was a strong 45% gain over the prior year's Q4 data and a big 17.5% increase from Q3 2024. However, that vehicle delivery growth was not enough to drive the top-line revenue quite as investors had hoped. Total revenue jumped 15.2% from the prior year and increased 5.5% from Q3 2024. These numbers suggest that NIO is building its sales volume in its primary market of China, but the Chinese EV market remains hyper-competitive, with BYD and Tesla dominating both market share and sales volume. While the top line remained disappointing compared to the company's delivery numbers, there is a more positive metric hidden inside the data. NIO's vehicle margin checked in at 13.1% during Q4, compared to 11.9% during the prior year's Q4 and the same level as the previous quarter. This suggests that although NIO had to get more competitive on pricing, it was also able to reduce production costs enough to save its margins. So we know that NIO is expanding its sales and deliveries through existing and new brand launches, whilst simultaneously reducing production costs to save its margins. So why were both investors and analysts so disappointed by the Q4 earnings report? NIO's stock price had been on a steady rise through to March, right up until the company prepared to announce its Q4 results to the market. Although NIO's sales are growing, they are simply not growing fast enough to offset the significant losses on the bottom line. The most shocking number posted in the Q4 earnings report was the overall losses to the NIO business, coming in at a whopping 974 million, an increase of 40% compared with the Q3 losses. And these sorts of numbers are simply not sustainable for any business to stay afloat. Something needs to change at NIO, and it needs to happen fast. On the recent earnings call, William Li made a bold statement. The NIO CEO remains optimistic that the automaker will achieve profitability in the fourth quarter of 2025. He stated that the company plans to take aggressive cost-cutting measures and operational restructuring to reach this profitability target. Now, I think this is unlikely based on the current sales numbers, but not impossible. What do you think? Leave a comment below if you think NIO can do it. And during the company's earnings call on March 21st, Li told investors that negative public sentiment had significantly impacted sales of its Onvo brand, with sales volumes coming in 30 to 40% lower than expected targets. The company also faces pressure from geopolitical trade tensions. For example, the European Union approved tariffs on Chinese EVs last year. This came as the EU found out that EV makers in China benefited from massive government subsidies, allowing them to undercut rival producers. Additionally, the US raised tariffs on Chinese EV to 100% last year under former President Joe Biden. And now President Trump has now announced a 100% tariff on Chinese-made dominate EVs, locking NIO out of the US market. NIO is making progress and continues to grow its sales and top-line revenue. However, the company continues to struggle with operating losses and slower sales of its Onvo brand that could limit its growth this year. While the company is taking some necessary cost-cutting measures, it remains to be seen if these planned cuts will be enough to turn a profit in the fourth quarter of this year, as the CEO expects. Another reason for negative investor sentiment is the company's financial guidance for Q1 2025. NIO now only expects to deliver around 43,000 vehicles during Q1, which would provide a revenue of around 12.9 billion yuan. Now, this is well short of the 65,000 vehicle target previously stated by NIO management. And this reduced Q1 guidance has upset investors, causing many of them to sell out their stock and look for another opportunity. And for investors that are still hanging on to their NIO stock, they're asking a big question. Will NIO ever reach profitability? And when will this happen? According to CEO William Li, Q4 2025. But investors are not convinced. One of the biggest questions investors have is, how does NIO plan to reduce the massive losses posted in Q4? Now, NIO is aggressively cutting costs to maintain vehicle margins, but at the same time, it's still spending huge amounts of cash expanding its battery swap network, which is a key part of the NIO product offering. It does not appear spending on the swap stations and the expansions will not stop anytime soon. So cost savings will have to come from somewhere else. Where these big savings will come from is anyone's guess at the moment. On a positive note, NIO has recently partnered up with CATL, the world's largest battery supplier, with the goal of creating the world's largest battery swap network. NIO and CATL are establishing the world's largest and most advanced battery swapping service network for passenger vehicles by leveraging their strengths in technology, management, platforms, and brand influence. Additionally, they'll collaborate to drive the formulation and adoption of a national standards for battery swapping in China to enhance battery compatibility across different brands and models. Initially, NIO and CATL will focus on strengthening their sharing of battery swapping network and accelerate the development of battery swapping services. CATL will support NIO in expanding the battery swapping network, whilst its own ChocoSwap technical standards and network will be integrated into the newly developed models of Firefly, NIO's new brand. Both parties' networks will operate concurrently, providing EV users with a more seamless and efficient swapping experience, thereby making battery electric vehicles more convenient. Furthermore, CATL will invest up to 2.5 billion yuan, around $346 million into NIO Power, solidifying the partnership. CATL already holds an 11% stake in Wuhan Weining Battery Asset Co. Limited, a financing entity established in 2020 to manage NIO's battery leasing business, also known as Battery as a Service. So, what does all this mean for NIO investors going forward? NIO missed estimates and gave weak Q1 guidance, but its Q4 wasn't terrible. To counter Chinese EV price war, NIO needs to refresh vehicles, launch new ones, and find revenue without drastic price cuts. If NIO sales growth aligns with its vehicle delivery growth whilst cutting costs, 2025 could be a strong year. However, questions remain about its battery swap strategy, overseas expansion, and slow top-line growth. Management aims for profitability in Q4 2025, but to achieve this, may need to double the planned sales to offset the ongoing EV price war. If you've enjoyed my analysis of NIO, subscribe to the channel for more videos. Last week, NIO stock fell by around 7%, causing investors more hurt as this stock continues to underperform the broader market. So the question is, should you keep holding NIO stock if you're already invested, or perhaps should you buy more at this bargain price? In this video, I'm going to talk around the current price action of NIO stock and just offer a few insights of perhaps future price direction. So firstly, we can see that last week NIO did fall around 7%. On Monday, it opened at 367 and closed at 381. Tuesday, the price pushed higher before Wednesday, Thursday and Friday were bearish days, with Friday having a large sell-off in tune with the wider market downturn. And NIO did fall through this key 360 support level last week. And it looks as if now it's trying to find support around this $3.20 level. And looking at Monday's price action, it does appear that some buyers have come in at the 320 level to push price back up. And we do have a reversal bar suggesting there is some support here with some buying interest. So it'll be interesting to see what NIO does this week, whether it pushes up higher and tries to get back above this 360 level. And if we look at the bigger picture on the weekly chart, we can see NIO has been in a downtrend since the peak of around $66 back in January 21. So it is in a long-term downtrend. More recently, the price action has been sideways from this low in April 24. And for a short time, it did look as if it was trying to break out to the upside by breaking through this short-term trend line. But if you look closely, it found resistance at around $7.60, which is the bottom of the longer-term trend line. So clearly there is resistance here at this 770 level, and price needs to get above here to really show that NIO has some momentum and buyers are coming back into this popular EV stock. So following the breakout of the trend line, it tried to push up, but the selling pressure was too strong, and price then fell away into the low in January 25 of around $4. And then of course, after a small pickup here up to 541, price fell away following the negative earnings report and the wider market downturn last week. So NIO has now fallen through this key support level of around $3.60, where it found support back in April 24 and also August 24. However, last week it did fall through this key level and is now looking to try and find support around the $3.20 level. So Monday yesterday showed some buying interest with price reversing, but of course it's just one day. We need to see what the entire week will do, whether the selling pressure will continue or if buyers are going to come back in and push the price back up. So right now the risk is towards the downside with NIO, and you may be wondering whether, because price has dropped, you should buy more stock. And that's up to you. At the moment it's high risk, and it does depend on your overall strategy. If you're looking to trade this stock short term, now's not the time to buy in. But of course, if you're accumulating this stock for the long term, maybe 3 to 5 years, then you could consider buying into NIO. But it is high risk. And based on the financial reports after the Q4 earnings report, it doesn't look good. So it may be best to wait until the financial health of the company improves. Now, if NIO fails to find support at this temporary level here of $3.20, where could it go to next? Well, based on the chart, it looks as if there is some support around this level here, around $2.30. And then if it falls through there, it might go down to the $2 mark. Beyond that would be the all-time low, which is around $1.20. And that was made back in September 19. So right now, the technicals indicate NIO is falling and is a high-risk investment. It's always tempting to buy more stock when the price appears more attractive, but how can you confirm the price has stopped falling? Right now, if you were to look at this chart, it's clear the price is going down and NIO is in a long-term trend. The long-term trend is down, the medium-term trend is down, and also the short-term trend is down. So any way you look at it, the price is falling. So buying in now is very, very high risk. So when would be the right time to buy into NIO? It all depends on your investment strategy, whether you're looking short, medium or long term. Based on the chart data, it does appear that price would need to break this longer term trend line here and get above $6 to really show that it's starting some upward trajectory. moving above $6 would clear all this price action here and would indicate that NIO is starting to move up. And I think based on the previous price action, getting above this peak here of 770 and breaking the trend line would indicate that NIO is starting to make a move up. So if you were to enter above the $6 mark, there is an upside potential to the 770 peak of around 30%, which is great. And if you kept holding and NIO continued to trend upwards, there is an upside potential of 150% up to that peak of around $15.50. So there is lots of upside with NIO, but right now the price is falling, so you have to be cautious. Right now the NIO trend is down and investor sentiment is very negative, especially after the Q4 earnings report. NIO just didn't deliver the numbers that investors were expecting and posted heavy losses. Now, of course, we know they are investing heavily in infrastructure and launching multiple brands this year, including the ET9, NIO's Firefly, and also the Onvo L60. But the sales are improving, that's really positive, but they're not enough to drive the share price and convince investors to come back in. But that might change over 2025. I think this year is going to be a key year for NIO. If they can start to boost sales and start to reduce their losses, I think investor sentiment is going to shift and money will come pouring back in. So right now, if you're holding NIO, whether you keep holding it, that's up to you based on your strategy. But it is high risk to be buying in right now. I think it's probably best to wait a few months to see where price moves and if it can break that long-term trend line and get above $6. Thanks for watching.